You were about to hear a tremendous interview with Dr. Marc Faber, but first, this segment is sponsored by Continental Gold, which has one of the highest grade gold deposits in the entire world. The company's flagship high-grade gold and silver project, Buritica, has extremely high 97 to 95% recovery rates for gold and silver. Buritica has gold resources of 1.6 million ounces measured and indicated and 3.4 million ounces inferred, with grades averaging over 12 grams per ton of gold, and high-grade silver resources of 4.3 million ounces measured and indicated and 10.9 million ounces inferred. The company has high priority targets to be drilled at Buritica and a portfolio of other potential high-grade exploration projects, and all projects are 100% owned. Continental Gold has over $120 million of cash in the bank, and management also owns roughly 18% of the company. Continental Gold, symbol CNL in Canada and CGOOF in the U.S. This is King World News. I'm Eric King. Remember to go to our homepage where we've already had billionaire Eric Sprott and Bill Fleckenstein, but without any further delay, here is Dr. Marc Faber. Joining us now is Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report website, www.gloomboomdoom.com. Marc, I wanted to ask you first, what are you seeing on your travels?
What I'm seeing? Well, in Asia, where I travel mostly, I see essentially hardly any growth. It's not that we are in a recession, but after a strong recovery, driven mostly by rapid household credit growth between 2009 and now, we have reached a level from where the economies, in my opinion, will hardly grow.
Why do you think there's no growth happening in Asia?
Well, I think there has been a lot of borrowings on the household sector level, and also, although today the export figures from China looked better, in general, exports from emerging economies have been stalling. So there is at the present time the combination of hardly any export growth from emerging economies and highly leveraged economies in terms of the household sector. And, by the way, government debts have also increased. So whereas we had in some countries like the U.S. minor deleveraging in emerging economies, we had further leveraging, which in my opinion has reached now a certain level from where growth will be more difficult to achieve. And when I travel to the U.S., I can see some improvement in the economy, but like everywhere else in the world, it's that the economy of the very well-to-do people, say not even the 1%, the 0.5%, a 0.25%, is doing very well. The luxury restaurants, high-end housing, high-end car sales and so forth, that is doing very well. And for the middle class and the lower classes, I don't think that the economy has improved at all. In fact, in real terms, in other words, inflation adjusted, it's gotten worse. And in Europe, I think the economies are kind of bottoming out, but we are far away from any strong cyclical recovery.
Dr. Faber, has China been setting itself up? You were speaking earlier about the lack of growth in China. Has China been setting itself up for problems in the future with the size of its banking system and their own money printing?
Yes, I'm convinced that there are problems that will occur in China in terms of the economy. We have had a very strong credit growth. Without that credit growth, the economy would never have expanded by as much as it did. At the same time, we should be aware that the Chinese economy, which has grown dramatically since the early 1980s, will, of course, also have recessions the way the U.S. had recessions over the last 200 years. It doesn't mean that China cannot expand further in the future. But right now, my sense is that in 2014, growth will be lower than expected, and that the statistics that the government publishes, like everywhere else in the world, are somewhat misleading.
What is the biggest danger in the financial system or to the financial system globally as you see it today, Marc?
Well, basically, the financial system had a chance to essentially heal after 2007, 2008, but it did not happen. banks were bailed out, companies were bailed out, and essentially whereas private debt may have somewhat contracted, government debt everywhere have been increasing. And an economist, William White, who used to be at the BIS, he calculated that today the leverage in the advanced economies is 30% higher. In other words, credit as a percent of the economy is 30% higher than it was at the peak in 2007. So the financial sector has continued to expand, whereas the real economy has basically hardly expanded or even contracted in most countries. And this diverging performance between financial markets and the real economy, in my opinion, is rather dangerous, because every inflation eventually comes to an end. So we had consumer price inflation in the 60s and 70s, and it came to an end. We had a period that was followed by not deflation, but disinflation. And then we had the great Nasdaq inflation, and it was deflated. And before that, we had the great asset inflation in Japan, real estate and stocks. And after 1990, it was also deflated. And my sense is that all asset markets have become very vulnerable and are dependent on central banks continuing to support them with asset purchases. And that, I think, is a very dangerous situation.
How will that end?
Well, that is a very good question. Nobody knows exactly what the end will entail. But as you know, since the summer of this year, the Fed has been talking about tapering. And given that the unemployment rate, according to them and the BLS, has dropped to 7%, they should be tapering. But there is no talk of an exit strategy. When QE1 was introduced in November 2008, people talked about an exit strategy. Now, the question is not about exit, but it's about just diminishing the asset purchases. And up to the end of November, the Fed has purchased not $85 billion worth of assets a month, but over $100 billion a month because of the accruing interest that they obtain. So basically, to stop the asset purchases would have a very negative impact on the asset market. And my sense is the market, nobody knows how high it will go. It can go up, and nobody knows at what stage the impact of the Fed's asset purchases will lose their power. But it would seem to me that there will be a day in the future when the question for the Fed will be, do we take the risk of having declining asset markets, real estate stocks and bonds, or do we continue to support the asset markets in order to kind of keep the economy rolling? And my sense is that even if inflation picks up, they may not tighten monetary policies. So over time, I would imagine that there will be more consumer price inflation.
When you talked about the massive and growing government debt around the world, Mark, should government theft be a big concern for investors going forward?
Well, basically, my view is that the world would be a much better and wealthier place if governments were much smaller. I think the threshold of government expenditures as a percent of the economy before these expenditures become a burden on the system is around 20, possibly maximum 25%. And in the Western world, in Western Europe and in the US, total government expenditure, states, local, municipalities, amount to almost 50%. And that is a growth inhibitor. It is completely wrong to assume that with this burden on the system, the economy can grow at the same rate than if government expenditures were just 20%.
Mark, I wanted to ask you today, what are your major predictions for 2014? Any surprises out there?
Yeah, I'm just thinking about this. And the more I think about it, the more I feel that we all don't know how 2014 will end. First of all, we have geopolitical tensions that are rising, particularly in Asia. And who knows what this will lead to. I don't think that a war will occur, but the tensions could escalate to a point where they would have some impact on the Asian economies and on the currencies of the Asian economies, notably the yen. So whereas I admit that to short the yen is an extremely crowded trade at the present time, everybody shorts the yen and long the Nikkei, I still feel there's a good chance that the yen will continue to weaken. That would be favorable for the US dollar. Now, against all expectations, this year, the euro has rallied against the US dollar. I think the Eurozone economies are probably in a worse shape, and the financial system is in a worse shape than the US. So I would also rather be long the US dollar than short the US dollar, also because of the increased energy self-reliance in the United States. Concerning the share markets, the big question is this. Since 2010, we had a massive outperformance of the US vis-a-vis emerging economies. The US cyclically adjusted price-earning ratios are relatively high, elevated, which would indicate low returns for the next 7 to 10 years. In other words, returns in the opinion of Jeremy Grantham of less than 2% negative in real terms for each of the next 7 years. Conversely, in emerging economies, we had bear markets, in some cases adjusted for the depreciation of currencies like the Brazilian real and the Indian rupee and so forth. We had declines of, say, 30 to 50% from their highs. So the question for the investor is, do I buy the US? That is currently still momentum driven, but it won't be driven forever. Or do I gradually move into emerging economies? So I think it's too early to move into emerging economies, and I think it's too late to buy US stocks. They may go up another 10%, maybe even 20%, but the risks have increased significantly, and I don't think that equity investors in the US, aside from a short-term trading opportunity, will reap very high returns in the future. Now, compared to equities in emerging economies and equities in the US, what is really incredibly depressed are mining companies. Now, my preference has always been to own physical gold, but I have to say that at this level, the mining companies are relatively good values. I mean, I'm not optimistic about any asset class, whether it's art or collectibles or bonds or equities or commodities, but relatively speaking, probably commodity-related stocks are very cheap. And don't forget, in 1999 to March 2000, there were a handful of technology stocks that went ballistic, and the so-called old economy stocks were all sleeping. And when the Nasdaq collapsed, the old economy stocks came back. So my sense is that actually, as a contrarian, and also given the extremely negative sentiment about gold and silver, platinum, palladium going into 2014, I think actually that the mining sector looks reasonably attractive.
Mark, any surprises, major surprise that you expect for 2014?
An attack against Iran. We can have skirmishes between Japan and China. We can have natural disasters and so forth and so on. We always have to be mindful of unpleasant surprises. A big surprise could also be that since essentially the lows in 2011, in October 2011, the U.S. stock market is up almost 70%. And from the lows in March 2009, we're up close to 170%. I mean, it's conceivable that we go into a real bubble. That could be a surprise. But as you know, bubbles do not end well, and most people lose money in bubbles on the way up and on the way down.
The coming inflation you expect, Dr. Faber, how bad do you think that will be?
Well, this is really a big issue for investors. As you know, some people, they belong to the deflationary collapse camp. In their views, the whole debt bubble will implode, and it will cause the S&P to collapse to, say, 400, and gold to go down, maybe less than the S&P, and bonds to collapse either through default or through high interest rates, and real estate to decline further. And other people, they think that inflation will accelerate and bring about multiple correction or multiple downgrade in equities, and of course a bear market in bonds. Now, both could happen, but at different times. I could imagine a scenario where the economy continues to kind of perform relatively poorly. In that scenario, the Fed will continue to essentially print money, in other words, purchase assets. And that asset purchases may one day spill over into consumer prices. Because don't forget, say, if you go to Hong Kong and Singapore, most products are more expensive than in the U.S. Why? Because the real estate in these cities is far more expensive than in the U.S., and so the retailers charge higher prices, all of them. And asset price inflation in time spills over into consumer prices. So far, it's spilled over mostly into consumer prices of the super rich. But at some point, it may spill over into the consumer prices of the middle class and the lower class. And by the way, although commodities have performed very poorly since the peak in July 2008 for the SCRB, oil price is still close to $100 a barrel, whereas in 98 we were at $10 a barrel or $12 a barrel. In the case of, say, gold, we are still at $1,200 an ounce, whereas in 99 we were at $252 an ounce. I mean, there has been inflation in the system. I'm on the board of some mining companies. I can tell you, if the oil price drops below, say, $80 a barrel, and if copper prices drop another 20% and gold prices go below $1,000, there'll be no more exploration. Finish. Because the costs have gone up dramatically. And every family around the world knows very well how their health care bills have gone up, how their insurance premiums have gone up, how their transportation costs have gone up. So I can't understand people who have been talking about deflation for so long. There's only deflation in the brains of the brainless Fed governors, because maybe they never shop, maybe they don't eat, maybe they don't drive, I don't know. But the fact is simply your cost of living have gone up since 1999 up to today by close to 100%, as have mine. But the salaries have not gone up by 100%.
Dr. Faber, would you mind talking about what you were buying and what you are selling right now?
Well, actually, the most hated asset at the present time, aside from gold and silver, and hated even more so, is cash. Nobody wants to hold cash because everybody knows that the purchasing power of cash is diminishing. You have zero interest rates, you have costs, and you have increasing asset prices, and you have increasing consumer prices. So nobody wants to hold cash. Now I say to myself, let's say if you are an investor who was reasonably attuned to the market swings of the last 10 years, you were essentially out of stocks or had reduced positions in 2007, but then piled into equities at the end of 2008, 2009, which I did. And now these equities, they have appreciated dramatically in emerging economies until, say, 2010, 2011, but in selected markets until May of this year. The U.S. market has continued to go up. But in general, if you were in equities, you may say over the last couple of years, 150% on your money. And in my view, now is the time to reduce equity positions. It may take a while until they come down, but when they come down, don't forget that equities usually go down at a faster pace than they went up. So I don't mind being in a large cash position waiting for a decline. My only concern is, how do you hold your cash? Do you hold it in treasury bonds, bank deposits? What is safe? And here comes the other equation. We had elections for the mayor of New York, Bill de Blasio, and the tendency nowadays is for the majority of voters who are not the 0.5% that benefited greatly from the asset price inflation to essentially support candidates that increase taxes on the evil rich. And everywhere in the world, except, say, in emerging economies, but, say, in Europe and in the U.S., I can see this tendency of the electorate wanting to increase taxation on the well-to-do in one form or the other. Either the introduction of a wealth tax, say, if you came to the American people and proposed to them, or in Europe, that people with assets of over $100 million should pay a one-time wealth tax of 50%, I think most voters would vote for that.
Well, this leads right into my next question and final question, Dr. Faber. You meet with some of the wealthiest people on the planet for private consultations. What are they doing with their money? What are they concerned about these days? You just mentioned the confiscation.
Well, I mean, very well-to-do people, they own real estate. They have investments, obviously, in hedge funds, which haven't done well this year and last year neither. They have money in equities. They have money in cash and bonds. And they have money in gold, diamonds, and a lot of well-to-do people have parked their money in art, and they are diversified. Well-to-do people in general are not completely stupid. They are aware of the risks. They are aware that there is a disconnect between the asset markets and the well-being of the average household. And so they are concerned. So they are diversified. Like I said to you at the beginning of the interview, we don't know how 2014 will end. All I can say is that money printing by central banks will end very, very badly. There's no doubt about this. But before it ends very badly, in the case of Mexico, when they, and other Latin American countries, when they printed money in the 1980s, in the case of Mexico, the market went up 343 times in Mexican peso terms. In other words, you had a huge increase in stock prices before the system essentially collapsed. The same happened in Argentina and Brazil. But the currency collapsed, obviously, so in dollar terms at that time you didn't make any money. Now, I could see a situation where these professors who've never worked a day in their lives at the central banks continue to print money, but in real terms, asset prices no longer go up. And given the geopolitical uncertainty and also given the very significant correction we had in gold, I would think that around this level, gold is relatively attractive.
Dr. Marc Faber joining us out of Asia. Thank you, sir.
It's my pleasure. Thank you. Take care.
Be sure to tune in as we will continue to release interviews with the top people in the world throughout the week. Also, make sure to check out the King World News blog.